Hello, everyone, and welcome to Aberdeen's Latin American Equity Fund Manager Webcast. The Aberdeen Latin American Equity Fund trades in the United States under the ticker symbol LAQ. My name is Allison DuPont, and I'm the Senior Marketing Manager at Aberdeen Asset Management here in the United States. And I'm pleased to welcome our Fund Manager, Nick Robinson, on the call today. Nick is the Director and Head of Brazilian Equities and is speaking live today from Aberdeen's office in Sao Paulo. Nick is a member of our Global Emerging Markets team, and our office in Brazil is only one of Aberdeen's global emerging market office locations around the world. And without any further ado, I'd like to turn it over to Nick for today's presentation on LAQ.
Thank you very much, Alison, and thank you to everyone who has taken the time to listen in today to this web conference. The agenda for the web conference follows a similar format to what we've done previously, in that first of all we'll just do a quick refresher on the investment objectives and the fund itself. Then we'll talk through in some detail the performance of the fund over the last few months, and also how the fund is positioned regarding the various countries and sectors where the fund invests. And then we'll finish off with a few slides on outlook and summary. So the key facts of the fund are detailed on this slide. Essentially, it's about $250 million in terms of net assets. NAV per share is something slightly under $35, trading at a discount to NAV at the moment of about 9%. It's managed by us, Aberdeen Asset Management, and specifically the Emerging Markets team at Aberdeen Asset Management, and we're based in various offices around the world, but the fund itself is managed predominantly between the two offices that we have in London and Sao Paulo. On performance, here we have a table that details the performance data of the fund, both over the last few months and also back to inception of the fund. Certainly the last few months have been a tough period for emerging markets. You've seen a rotation really into more developed markets, as some of the economic indicators in developed markets are beginning to look a little bit better, whilst some emerging markets are still showing quite slow growth. Latin America in particular has really underperformed the broader emerging market index in the year to date. And I suppose one of the big triggers for the weaker performance of the emerging markets, and specifically Latin America this year, was the Fed signaling the likely end of quantitative easing in the near future. And that really triggered a big wave of cash leaving the region, so big outflows from equity funds in the region. And that's also triggered quite sharp weakness in some of the local currencies, particularly the Brazilian real. So if we look at the 3-month performance data for the NAV, that fall of 16%, about half of that is related to currency movements, with the other half caused by the market weakness. In terms of the positioning of the fund currently, the fund maintains a broadly similar positioning to what we've had in the last few quarters, and very much it's a fund that looks to benefit from growth in domestic demand within Latin America. So these sectors in which the fund invests in are those sectors that you typically associate with being beneficiaries of domestic demand. Therefore, those kind of sectors would be things like the consumer sectors, the financial sector, which is a key beneficiary of domestic demand. And then against that, sectors where the fund has less investments would be those more exposed to the global economy and certainly more cyclical sectors, so things like the materials sector. And then we also generally avoid those sectors where you have more government interference and government involvement. So things like the utility sector, the telco sector are big underweights for us. And in terms of the top 10 companies, you can see from this that the majority of the holdings that we have are exposed to domestic demand. And really there's only 2 companies in the portfolio where we have some exposure to global commodity prices, and those would be Petrobras and Vale. Outside of that, it's very much domestically demand-oriented companies, with the largest position being Banco Bradesco, which is a very high-quality Brazilian bank, and also Brazilian banks feature reasonably heavily as the number 4 position is also a Brazilian bank. And then there's also some very high-quality consumer businesses in the top 10. So Ambev, based in Brazil, Lojas Renner, which is a Brazilian retailer department store that's very much focused on the middle-class consumer. So those are typical companies for us. And then breaking down in terms of the various countries in which the fund invests, within Latin America, the majority of the opportunity set is within Brazil, and so that's where the majority of the fund is invested. And certainly in Brazil at the moment is where we find the most valuation opportunities in Latin America, having seen Brazil having been one of the worst performing markets in the region in the year to date. So that's really throwing up quite significant valuation opportunities in selected sectors and companies. Elsewhere, the fund has a reasonable number of investments in Mexico, which is also home to some very good companies, although I would say in Mexico in the last 10 years you haven't had the same kind of development of capital markets as you've had in Brazil. So company choice in Mexico tends to be a little bit more limited. And then elsewhere, the fund has some investments in the smaller regional countries like Chile, Colombia, and Argentina. Although Argentina is really an investment that that has little exposure to Argentina, being a pipe manufacturer that is actually headquartered in Luxembourg with its main listing in Italy, but because of it, by virtue of having more than 50% of its business in Latin America, it fits in with the mandate of this fund. And this slide gives a little bit more detail for performance in the last 3 months, and I suppose there's a lot of numbers here, but essentially it shows that the fund on a gross basis outperformed the benchmark by some 30 basis points, and really this just breaks the performance down into countries and where did that performance come from. And really the answer is, our single holding in Argentina was beneficial to performance in the quarter, as was not holding anything in Peru, which was a very weak market. And then we also benefited from stock selection in Chile, which all added up to reasonable, small positive performance if you net off quite a negative performance from Mexico. And really in Mexico we suffered from not having very much, or having a less than benchmark position in Mexico, which we have really because of valuation in Mexico being expensive. And then B, we suffered from stock selection in Mexico. And really there was a couple of things there. One was that América Móvil, the large Mexican telecoms company, performed quite well in the quarter, and we don't own that. And then secondly, a holding we have in Banorte, which is a large Mexican bank, performed quite poorly, and that's one of the larger positions in the fund. So a couple of things there. And then this next slide, similar thing, it just breaks it down into various sectors. And the thing to point out here is that some of the more defensive sectors, as you might imagine in this type of environment, did a bit better. So some of the consumer sectors did okay, particularly or relatively okay, still quite a big negative performance, but the consumer sectors held up a little bit better, as did things like the telcos, which are typically a bit more defensive. And in this slide, we just break down the stock attribution into a little bit more detail. So which companies had the biggest effect on the performance of the fund during the last 3 months? And so the top performing company was Canaris, which is this Argentine company I've mentioned. And then things like Ultrapar in Brazil, which is a Brazilian company that runs gas stations as well as have other businesses. And then a holding we have in Soriana, which is a Mexican supermarket, also made a positive contribution. And then in terms of what had the most negative performance on the fund, like I mentioned, not owning América Móvil, and then our large position in Banorte were the two the two stocks that were most detrimental to performance. So moving on to the outlook for the fund. Here we just have a few slides on how we see things at the moment. And I suppose, firstly, things in the US are beginning to get better. And I suppose, that's really the reason for the Fed coming out and signaling the end of QE. And I think, that the US getting better should be seen as a good thing in the long term, certainly, although the end of QE has certainly increased risk aversion in emerging markets of late. But there's no denying that the US recovery is good for the emerging markets in the long term. There's continued concerns over China, and certainly in the second quarter, we saw more concerns over the Chinese shadow banking system. Certainly, Chinese demand is slowing, and there is some concern that could lead to commodity price weakness in LATAM. And as we know, commodities are an important part of LATAM economies, although perhaps overstated at times. But certainly, weakening demand for commodities could potentially cause commodity prices to fall. And we have been seeing, broadly speaking, some of the commodity prices falling recently, although interestingly less so iron ore, which is where the portfolio has most exposure via its holding in Vale. But certainly falling commodity prices could potentially put some more pressure on current accounts, and certainly we have seen some weakening in Latin American current accounts over the last few months, and correspondingly we've also seen this weakening in the currency, which presents some risk in terms of total return, as currency is an important feature of total return. But it's still not all bad news, as per this slide, in that public debt as a percentage of GDP, as per the left-hand slide, is still in pretty healthy position. And certainly, if you compare with Latin America with any of the more developed markets, you would see that government balance sheets are still in pretty good state. And certainly, GDP forecasts by country are still for relatively low forecasts, but should improve over the next couple of years. In Brazil, one thing that happened in the second quarter was we saw widespread protests throughout the country, which is something very unusual in Brazil. And I suppose Brazil really, almost following an example of what had happened earlier in the year in Turkey. Really, the protests were triggered by a relatively small increase in the bus fares in the country, and those initial protests were responded to quite heavily-handedly by the police, and that really triggered this wave of mass protests that we saw. And really, the big complaints over the protests were quality of infrastructure in Brazil and public services, particularly given the tax burden that Brazilians have in terms of the economy. And I suppose it's a tax burden that really compares very similarly with those tax burdens in more developed countries, but you very much have less developed country standards of services in Brazil. So that really triggered a big decline in President Dilma's approval ratings, and there's an election coming up next year. So that those kind of worries over approval have triggered quite a significant response in terms of investment in or increased investment in infrastructure, efforts to reduce corruption, and all those kind of things are now going through the parliament. But certainly on this slide you can see that Brazil does have poor infrastructure, and here we have the BRICS infrastructure ratings out of most countries in the world, and you can see that Brazil, even compared with the BRICS, Brazil compares very unfavourably, and certainly an awful lot of investment is required, and that's something the government is tackling. You can see that the government has launched an infrastructure program that approximately totals about 20% of GDP that should be invested over the next few years. So that's quite significant in terms of improving infrastructure, and also improves in terms of fiscal stimulus to help the economy get moving. And one of the key concerns over protesters was the amount of money that's being spent on World Cup and Olympic stadiums. And you can see from this chart that actually the amount of money being spent on building stadiums and the like is actually very small compared with what's going into the total infrastructure program. But obviously these stadiums and this kind of World Cup investment is much more high profile at the moment. In Brazil, we're quite heavily invested in the consumer sector in the funds, and certainly we think that the consumer story in Brazil remains quite well supported. Unemployment is still very low, and certainly recent economic data regarding employment has been quite strong. Consumption growth on the right-hand side has been a little bit weaker. There's, I guess, a couple of things going on there. Firstly, the big improvement in employment has happened, in that unemployment probably can't fall much from here. And then secondly, real wage growth is now a little bit slower than it had been. So consumption growth is a little bit weaker, but we see, no reason why consumption growth can't remain around the 3 or 4% type level going forward, given what is still a reasonable economy. And then in this slide, we just talk a little bit about consumer debt. A couple of years ago, consumer debt in Brazil was something that we were quite concerned about. But the good news is that things are getting better from that front, in that relative to consumer income, consumers have now been taking on less debt and even paying down some debt. And also you've seen consumers paying less for their debt as well, in that average maturity of debt has extended, and meanwhile interest rates that they're paying on their debt has declined. So really this continues to support what should be a reasonably robust outlook for consumer spending. And then looking at some of the other countries in the region, Mexico continues to be okay. Obviously, there's been a lot of optimism in Mexico over the last few months, particularly over the new government and the new reforms that have been long awaited but are likely to be made in the economy. These reforms are likely to be quite positive over the long term, but are still taking quite some time to work through the various channels in government. And while we're seeing these reforms being debated, we have seen some short-term weakness in the Mexican economy as the uncertainty over reforms means that some investment is being delayed. But certainly the economy itself is still doing okay. And likewise in Chile, things are still fine. Actually, things are okay in Chile. GDP growth is slowing a little bit. We're unlikely to see the kind of 5 or 6% type level that we've seen for the last couple of years, but it's slowing to levels more like 4%. And very much domestic demand remains quite healthy. And it's worth pointing out that in Chile, there's still an awful lot of room for monetary and fiscal stimulus should it be required. One concern, however, over Chile at the moment is that there's an election coming up in November. And it looks fairly certain that Michelle Bachelet, who was the former president of Chile, is likely to be re-elected. And one thing she's signalled that she's likely to do, if re-elected, is raise corporate taxes, which is potentially, I suppose, a small but potential negative to the stock market. And then having said that about the economies, one very bright spot at the moment is that valuations look very reasonable at the moment. And these charts here go to the end of June, but were we to take them further up to today, you'd see that valuations were looking even more attractive than they were towards the end of June. So on a forward PE ratio now, we're below the long-term average, or at least the average going back 10 years. And certainly on price to book, valuations are looking very good at the moment. So certainly feels like a very reasonable entry point to be investing in Latin American markets. Also, earnings growth is expected to recover this year. We've had a couple of bad years or poor years of earnings growth, and 2013 should recover. Although I would caution that these estimates are probably a little bit too optimistic, and we're getting into that time of year now where earnings estimates are typically revised down. So we would expect something much more in the single digits for 2013 and likewise 2014. But certainly, companies are generating earnings even in this environment, which is a little bit more difficult from a revenue perspective. So to summarize, we think volatility is likely to continue, and certainly a lot of that is driven by what's going on outside Latin America with the Fed tapering and also news flow out of China. Brazil, continues to be a slightly difficult environment with higher inflation, low growth, and rising interest rates. Mexico is certainly benefiting from the recovery in the US. In Chile, we have this election coming up, so there's a few country-specific issues to be aware of. But fundamentally, the story for Latin America hasn't changed in the last few months. Certainly, demographics are still very good with the growing middle class, and government balance sheets remain in very good shape. And the most important thing for us as bottom-up investors is that companies still remain very healthy. There's, in general, governance has been improving through the region, and the number of companies listed in the stock markets has increased. So as bottom-up investors, we have, in general, better companies to invest in and potentially more companies to invest in. So we see plenty of opportunities, and certainly this environment at the moment with weaker stock markets is giving us more opportunity to recycle capital from areas where it's done well into areas where it's done less well. So we continue to invest in good quality companies and pay reasonable valuations for those. So with that, I will finish, and thank you very much for your time today and for listening in.
Thank you very much, Nick, and thank you for providing such a bird's eye view of the Aberdeen Latin American Equity Fund from your office in Sao Paulo, Brazil. I really like the way your comments on the portfolio's positioning and how you tied that in with the outlook for the region and some of the fundamental items that Aberdeen frequently talks about, which is the favorable demographics and the rising middle class demand throughout the Latin America and the emerging market region in general. And that concludes today's webcast. Thank you again, Nick. And to our listeners, make sure that you're signed up for all the Fund Manager webcasts on Aberdeen's award-winning Closed-End Fund Talk channel. And we hope to speak with you again soon. Thank you again.